I'm getting really good at this. Hearing your thoughts. Yes, you can qualify for a mortgage. Yes, with your income. Let's discuss. I'm Mark McInerney, President and CEO of CodeMark Financial. Welcome to Mortgage Money Genius, where we teach realtors just like you how to get more referrals, become superstar agents, and double your commissions. How? I'm so glad you asked, my friend. By teaching you the realtor code and also teaching you all the things inside of mortgages so you can be a Jedi and ninja and superstar in there too. Today, I'm actually going to let you ride shotgun with me. Better yet, I'm going to share the screen with you on looking at income inside of a loan application that could potentially be yours or could potentially be your buyer's. Sit back, relax. 3, 2, 1.
I just wanna be your superstar, 'cause it's not where you are, it's where you are.
Okay, and we're back. So, yes, we have been talking for a decent amount of time, and I really appreciate you hanging in here. Look, there is something really good for you at the end of all of this, but you got to sit in and keep watching and wait and see. Just like today, though, I'm going to show you exactly what it looks like inside of a loan software program. So here's what a typical loan screen looks like inside of your mortgage professional. We're going to scroll down here and take a look at the most important part that people like to look at the most. Now, give me a second just to tighten a few things up here. Most people go for a 30-year loan, so let's plug in the numbers with the 30-year loan. And as this is being currently recorded, interest rates are at about 3.75, okay? And that just gives us a very safe calculation. Now, let's go ahead and say we've got a borrower that makes $10,000 a month, all right? They want to purchase a house for about $300,000, right? Because we've been talking about this calculation and multiplier of 3 that they would be able to qualify for based off of that income. We're about to put this theory to the test. Let's also go with the minimum down payment of 5%. So with 5% down, and I put that down simply because it's not to say that anybody can't get a house with more money down. They can. And here's actually something worth noting. If you're bringing more money to the table, well, of course, naturally, they're happy to reward that. How would they reward that? Well, with a little sweeter and juicier interest rate. But in this case, we're just going to calculate the minimum. Let's say 5%, and in this case, also conventional. All right? So, on a $300,000 payment or $300,000 sales price with 5% down, let's even go ahead and add some taxes in here, right? And what the heck? Let's also go ahead and put in some mortgage insurance. If you have a credit score that's above 750, mortgage insurance is no different than other normal insurance in that the higher your credit score, the lower your premium is going to be. So, because you guys are awesome and so are your buyers, we'll go ahead and just say that you've got a 750 or your buyer has a 750 credit score. That would probably put somebody around, let's just call it $100 a month in mortgage insurance. Now you see this thing creeping up here, right? This number over here changing is what is the debt to income ratio. Now notice, as it stands now, we've got a borrower with $10,000 a month in a monthly income. We have a $300,000 sales price. We have a 5% down with an interest rate of 3.75, and we basically have a fully loaded mortgage payment here. And what I mean by that is there's the principal and interest, there's the hazard insurance, which is AKA homeowners insurance. Give you a little game there. Taxes at about 3%, because here in Houston and the surrounding areas, it's going to be about that, and that's probably about the average through the state of Texas if you're watching us in some of our neighboring cities. But here, the mortgage insurance as well, like I said, we're loading it all up here. Now, what we haven't taken into calculation yet is the debts of this borrower, right? Because up here, we don't have any credit pulled. And as a matter of fact, we don't even have a real person to do so. However, with the general calculation of most average home buyers, they typically have a car note, and I'm getting ready to add some of these debts in here, and you'll start seeing this number here increase. But here's what's worth paying attention to first. With this basic profile, 10 grand, which is a $120,000 annual salary, about a $300,000 sales price with 5% down, a fully loaded mortgage payment, taxes, insurance, and mortgage insurance, we're already at a 23% debt to income. Your average car note is about $500. Okay? Survey says, watch that DTI change. Bing! 28%. All right? The average American has about 3 credit cards with an average of $100 to $200 a month in minimum monthly payments that they're supposed to make towards those credit cards. So, because I like to be conservative, meaning that I'm going to go on the higher of that range, that's 3 credit cards with $200 payments each. Let's take a look and see what happens there. Watch this number. Survey says, bing, 34%. Now, what else might your average American have on their credit profile? Now, this is where a lot of people get confused and they're like, oh man, I'm running away from some medical collections. That's okay, no problem. They might also say, oh man, you know, like I had a cell phone that I didn't like and they kind of ripped me off. That's okay too. These would fall in the categories of collections, okay? And your grocery bill and your bill to Starbucks, as much as those are probably quite expensive monthly, they aren't going to be directly affected to your debt to income. Why? Because they're not an installment loan or they aren't a line of credit. So those don't reflect on here. And when you have collections, in most cases as well, it's just considered bad debt and also doesn't calculate into a monthly installment because it's a debt that you had and it just sits there as a big boo-boo, yes, on your credit report, which more likely affects your credit score, but not the debt to income ratio because you're not paying on it anymore, right? Or your buyer isn't paying on it anymore. But in this country, a lot of Americans have student debt. And student debt is unfortunately crippling a lot of the youth right now to being able to purchase anything else. And of course, you guys are all being told, market to millennials, market to millennials, market to millennials. Well, they're the ones coming out with that heavy student loan debt. What does that look like? I'm going to say that the average on that is about $500 a month as well. As we talked about previously, the debt to income ratio you can't exceed on a conventional loan would be 45%. This borrower looks A-okay with the average debt that they might be carrying based off of these calculations. They're at a 39% debt to income ratio. They have all of this debt here. This is the proposed mortgage payment. That's subtracted from the $10,000, and I know not everybody makes $10,000 a month. What we're calculating here is based off of that multiplier of 3. Take a look at that. There's the interest rate. There's the sales price, the down payment. We include some debts, the full mortgage payment, giving us a qualifying debt to income of 36%. Remember, the whole objective here is to be able to rattle off and know some of these numbers, no different than you know the distance on how to travel to the airport. You know that it takes 30 minutes, but you also know that it could take an hour and 30 minutes based off of traffic. And that's why it's absolutely imperative to understand exactly what your mortgage person is saying when they're giving you a pre-approval letter and when they're pre-qualifying your buyer. But that's not going to happen in this case because guess what? Here at Mortgage Money Genius, we are teaching you the code, the realtor code. We're also teaching you how to be superstar agents because we like working with superstar agents and you want to work with the superstar mortgage company. So between you and me and them, they get that superstar experience. Do me a favor, would you? Be a superstar right now. Like, comment, and share this, would you? And go ahead and spread the love on being a superstar. And we'll see you next time. I'm Mark McInerney, President and CEO of CodeMark Financial. This is Mortgage Money Genius.